Zupi complied with the ban. So this is not the first time that Dream 11 experienced when it came to crisis management and reallocation of resources. Dream 11's user base, technology and which shade. Dream 11 is sitting on a cap. What would you do if your entire business crumbles down in 24 hours? Just 24 hours is what it took for the RMG companies to settle to dust after the policy changes were introduced within the RMG industry. Dream 11, My 11 Circle, Howzat, MPL, Winzo, Gamescraft, everyone affected, impacted, and battling for their survival. A 2.5 billion industry, over 200,000 employees impacted just in one day. All you are left with are just three options: fight, comply, or perish. And that is what most of the players within the RMG industry did. Leaders like A23 chose to fight, while MPL and Zupi complied with the ban. Perish, from what we can see, is the complete destruction of the RMG product in the portfolio for almost all the players such as Gamescraft and Pokerbazi. But amidst all this, what we are missing out is one company. Remember Rishabh Pant asking you to make your own team? Yes, the company with the strongest brand recall amongst all of these, Dream 11. Before we proceed further, if you're really liking our work, don't forget to subscribe to our channel. For us, it is the only source of motivation and shall be highly inspiring for us. So hit the subscribe button right now if you have not done it yet. Now, coming back to what did Dream 11 do, and most importantly, what is a pivot? Pivot is a major shift in company strategy, product or business model to adapt or grow. When the current model fails, market changes, regulations hit, or new opportunities arise, companies choose to pivot, and often this point is known as the inflection point. Let me share a small example with you. Imagine a car driving straight down a road when suddenly the driver notices a huge pothole ahead. That moment of noticing the pothole is the inflection point. And to avoid the damage and continue safely, the driver changes its path by turning the steering wheel and taking a new path. This is known as the pivot. In case of Dream 11, the inflection point was the ban on RMG gaming altogether. Dream 11 made three strategic changes to respond to this, and this deserves a place in the case analysis when it comes to business process continuity. Dream 11 stopped all the paid contests. It shifted to a free-to-play social gaming model, and it launched a new fintech venture called DreamMoney, a wealth management platform. Let us ask my favorite question here. Why? Dream 11 wanted to follow the regulatory policies within India to keep its business intact and operational. So they had no other choice but to cease all paid contests. Shifting to a free-to-play social gaming is a strategic adaptation aimed at user retention while staying compliant. While launching DreamMoney, that's a full pivot. A new business line targeting a different market, representing a complete strategic shift. And any guesses on how much time it took for DreamMoney to be launched? Just 1 week. DreamMoney, launched by Dream 11, is a wealth management platform that focuses into 4 key services: gold investment, fixed deposit without requiring a bank account, SIP planning, and expense tracking. The pivot makes it possible for Dream 11 to leverage the already existing user base of over 300 million users. To understand the product better, let us try to understand it from a 3-way lens: core product, actual product, and augmented product. Core product, the main benefit or need the customer gets. Actual product, the tangible features and design of the product. Augmented product, extra services that enhance the customer experience. When it comes to DreamMoney, the core product is enabling users to manage and grow their wealth digitally. It provides an easy access to investing and financial management that makes financial inclusion even more simplified. The actual product or the tangible features include the mutual fund investment starting at as low as 10 rupees, digital gold purchases, fixed deposits from as low as 1000 rupees without needing a bank account, and mobile first interface for ease of use. The additional enhancements and value additions that the product offers includes seamless integration with the Dream11 ecosystem, which leverages the existing user habits. More about this in the upcoming sections. Educational content and recommendations for better investing, notification and alerts for portfolio tracking, gamified experience elements, and personalized insights based on user behavior and transaction patterns. So how does Dream Money plan to execute it? Before we delve deeper into it, let us understand what is Fintech and how it differs from a neobank. When it comes to a Fintech, it's a company that's using technology to offer financial services like investing, payment, or lending. But when it comes to neobank, it's a digital-only bank. It provides its own accounts, cards, and payment services without physical branches. What is important to understand here is that Fintech by itself does not have any banking license, which means that it is just a technical wrapper focused on customer centricity, user experience, and service delivery. This is where Dream Money is positioned in the market. It partners with regulated entities to offer mutual funds and stock tracking, integrated with SEBI-registered AI advisor, digital gold investment facilitated through Augment, and fixed deposits offered in collaboration with small finance banks like Suryodaya, Shivalik, Slice, and other NBFCs. When a user invests, Dream Money routes the transaction to partner fund houses, and the payments go directly from the user's bank to the partner, not through Dream Money. So what does Dream Money actually offer? Automated payment processing, API integrations, liquidity, and netting. The revenue model and monetization strategy of Dream Money is actually interesting. Its revenue mix is a combination of indirect platform fee and direct partner fees. Let us try to understand the revenue stream model. The three major sources of revenue streams are commissions, referral fees, and distribution fees. They receive commissions in the form of trail commission and upfront commission from mutual fund houses. When it comes to the referral fees, the partner of digital gold investment, Augment, pays the referral fee at a slight percentage of around 0.05 to 0.2% as per the industry norms. The distribution fees are paid by the banks or NBFCs, which is often considered as market development fee. It is a small fraction of the FD amount which comes through their platform of Dream Money. Now, when it comes to the cost to the investor, the referral or distribution fee for fixed deposits and the referral fee for digital gold generally bears no direct cost to the investor, while the trial commission and upfront commission that is to be paid by the mutual fund houses to Dream Money has an indirect cost to the investor. A question that has been in my mind for a pretty long time is, what made this pivot possible so quickly? So this is not the first time that Dream11 has faced regulatory hurdles. Back in 2023, when they launched their UPI payments app DreamX, partnering with Pine Labs that holds a PPI license, it eventually got shut down. Why? Same reason, regulatory problems. RBI directive to halt UPI services launched under co-branded arrangements resulted in halting of DreamX. Why? To prevent unauthorized transactions, avoid regulatory compliance issues, and uphold customer protection. So the leadership of Dream11 had the experience when it came to crisis management and reallocation of resources. This imbibed into the team culture, making it proactive, strategic, and agile. After this ban, this experience came in handy. What we tried to analyze were the key resource advantages that Dream11 had, which made this transition so quick and so possible. The framework we use here is resource-based view. Resource-based view, or RBV, is a strategic framework that focuses on a firm's internal resources and capabilities as a primary source of competitive advantage. The key principles are to identify the resources that are valuable, rare, inimitable, and non-substitutable. When we look into the resources, we can list them down as technology infrastructure, API integrations, data analytics and AI, brand trust and loyalty, leadership and vision, capital and funding, regulatory expertise, partnerships, and customer base. Now let us try to dig down to the next level for the resources. When it came to technological infrastructure, Dream11 boasted of modular, cloud-native microservice architecture, enabling rapid pivot and fintech integration. They have an in-house platform, Scaler, with AWS to automate scaling through high-traffic events, reducing operational strain. APIs provide the real-time interaction with gaming and fintech partners, while data analytics and AI offer behavioral insights from 300 million plus users, allowing personalized investment recommendations. Being a credible brand led by proactive leaders Harsh Jain and Bhavit Sheth, Dream11 is sitting on a capital of over $1.165 billion raised from top investors, ensuring that cash crunch should not stop their pivot. With regulatory compliances checked already and housing over 300 million plus users, Dream11 was in a sweet spot to pivot to Dream Money. The VRIO matrix looks somewhat like this. So what does this matrix tell us? It talks about the sustained advantages for Dream11 that enabled it to pivot to Dream Money, which are brand trust, leadership, AI data capabilities, tech infrastructure, and customer base. They are hard to copy and code to pivot. When it comes to temporary advantages, it includes capital, API integration, and regulatory partnerships. Useful but easily replicable if funded by the competitors. And how do these resources align with different stages of the pivot? Let us divide the stages of the pivot into 3 categories: fast mover advantage, fast adoption for Dream Money, and quicker execution speed. When it comes to the fast mover advantage, the valuable, rare, and inimitable resources allow Dream11 to rapidly enter the fintech without starting from scratch. When it comes to fast adoption, the customer familiarity with digital transactions plus AI insights help Dream11 to pivot into Dream Money. And when it comes to quick execution speed, the credit goes to the modular technology, strong leadership, and agile teams that help in quick redirection. When it comes to the capability market fit, Dream11 exactly knew what the market needed to make the transition into the smart wealth management market. It understood that the market demands were a low-friction micro-investment strategy along with quick account onboarding with compliant financial products and user centricity, reducing the complexity when it comes to digital investments. Based on this, they designed or reused their internal capabilities such as user habit of microtransactions, pre-completed KYCs, regulatory partnerships, and a simplified digital wrapper. The advantage: smooth adoption, low onboarding friction, fast license, free entry, and easy user experience that builds trust. And the outcome: faster uptake by existing users, instant mutual fund, fixed deposit, digital gold accounts, rapid launch of Dream Money, and a higher engagement and usage. All these makes Dream Money poised at a very good state when it comes to entering the wealth management market. Strategically, Dream11's user base, technology, and partnerships align with the fintech opportunities, enabling a smooth, rapid pivot to Dream Money, which made it possible for them to launch it within a week. So what should Dream Money do next? Dream Money is a new fintech product offering mutual funds, digital gold, and FDs, expanding beyond Dream11's fantasy sports platform. It targets existing users initially and aims to reach a new non-gaming investor market where people are completely okay with microtransactions. Next step should be to deeply penetrate and engage the existing Dream11 user base with tailored financial education and simplified onboarding to drive Dream Money adoption. But why this single critical step is going to be very helpful? Let us understand it from the early launch strategy and market fit metrics. The existing user base is digitally engaged, familiar with microtransactions that serve to be the strongest target market. When it comes to behavioral alignment, the gaming habits such as risk taking, quick decisions, mobile first naturally fit the investing and personal finance mindset. Frictionless onboarding, which includes simplified user journey, low entry SIPs, digital gold and FDs, reduce the entry barriers and boost conversions, while the early adoption impact such as building trust, enabling upselling and premium services can help Dream Money to secure a larger market share before the rivals. This is known as the first mover advantage. Scalability. When it comes to scalable growth, the core users here drive network effect and word of mouth that can help Dream Money to grow organically and sustainably expand into this new market. It is going to be truly interesting to find out how Dream Money grows in the new market that they have established for themselves. But what is commendable right now is the pivot, the business process continuity, and the exemplary agility shown by the leadership when it comes to completely moving into a new market instead of crying over the spilt milk.